Hello, I'm Jay Van Sciver, the Industrial Sector Head at Hedgeye Risk Management. And today we are joined by Ben Axler to discuss two of his new favorite short ideas. You might recognize Ben from an earlier appearance on Hedgeye TV when he pitched iRobot as a short, one that worked out very well. Congratulations. And today we're going to talk about two names, Ametek and Greif, that Ben has some interesting insights on. So Ben, just as a start, can you give us a bit of the background and your thesis on Ametek?
Sure. Well, Jay and Hedgeye team, thank you again for having me. I really appreciate it. And the timing is a little bit uncanny, as this morning I pulled up the news and saw that Warren Buffett had talked about some of the things he disdains when looking for stocks, and mentioned investment bankers are always pitching him companies he should buy at 30 or 50% premiums, and then 3 years later coming back with a straight face and saying they should spin off the same assets. Well, you know, both of these companies we're going to talk about are almost the antithesis of what Warren Buffett would look like. We're going to talk about companies that are serial acquirers that tend to overpay for assets, that have stocks that are significantly overvalued in my opinion, companies that are opaque and have very little alignment of management with shareholders. And so the first one that you mentioned that I've done an extensive amount of work on is Ametek. Ametek is a diversified industrial. They are effectively a roll-up of test and measurement equipment companies. They do about $4 billion of revenue a year. The issue I have with Ametek is that their core business, which was vacuum motors, has effectively been commoditized and moved to Asia. And so they needed a new growth driver. So about 10 to 12 years ago, they started buying up every test and measurement company they could find. And they've bought about 60 companies and spent $4.5 billion of capital for these acquisitions. Now, doing this has created a lot of issues. When I look at companies that are serial acquirers, I look at them after the capital they spend for the acquisitions, as well as after the CapEx needed for the business. If you look at this over the long run, it's not clear that Ametek has generated net positive cash flow. Digging a little bit deeper beneath the surface, I think Ametek's organic growth has really started to hit a wall here. In fact, the past 2 years, they've missed their internal estimates for growth, which were only very modestly set at 4 or 5%, effectively came in near zero, okay? But during this time, over the past 10 years, Ametek has only missed Wall Street estimates once. Now, you know, I've advised companies on M&A, I've been through M&A myself. It's incredibly hard to acquire and integrate businesses and meet numbers quarter after quarter with such precision. So here I say to myself, this is a story that's too good to be true. And I started digging a little bit deeper after I saw this and found that Ametek's gross margins and EBITDA margins were significantly out of line. So Ametek reports 26% EBITDA margins and only low 20% gross margins. I did an analysis and plotted this versus other peers. I determined through additional, legwork that their EBITDA margins are, call it 500 basis points higher than they should be. And this is a consequence of the aggressive acquisition strategy. So what this allows them to do is capitalize a lot of the costs on the balance sheet. If you look at their asset base, it's effectively 70% goodwill and intangibles. So what they're doing is buying research and development and buying products that they're not developing internally, so they don't have to run that R&D through the income statement. They acquire these companies, effectively dissolve them and starve them to the point where it might allow them to make a quarterly number, but then over time the growth wanes and they're left with what I think are a graveyard of really bad, mediocre businesses. And so they've been doing this strategy for a while now, and I think it's really starting to hit sort of the head here, so much so that there's been other red flags that have come to the surface. So a few years ago, there was an SEC whistleblower complaint. An individual that worked at one of their businesses, Chandler Engineering, said that he was terminated because he reported to the CEO that the company was intentionally manipulating their inventory and revenue recognition. This is very serious stuff. Now,
it was shipping at 2:30 in the morning or something, if I remember.
Exactly.
That's when Hedgeye does all of its shipping.
Of course. Now, that whistleblower case never was proven, never went anywhere. But fast forward a few years later, the controller of the business unit and the VP of finance of one of Ametek's major divisions was indicted by the FBI on criminal charges for fraud and for defrauding Ametek, curiously, by submitting phony travel expenses.
So Ametek is the victim here, is what you're saying?
Ametek's the victim, absolutely. Now, this really got my attention, and so I started to really focus my research effort on, what's happening with Ametek's inventory. So what I did was I went across the world and pulled every financial statement I could find on Ametek from every country that Ametek had to report to. And
some very cool material that you were able to find in your report.
Thank you very much.
Which I actually did. I read it. I feel like Jon Stewart saying I read your book.
A lot of the criticism I got was that it's a 700-page report. And
it was really long.
A lot of it was the appendixes of all the documents, but you drill down to the core here, and what I found was Ametek's auditor, Ernst & Young, has been auditing them since 1930. And so they have a very special relationship, with the auditor, so much so that the auditor gave the CEO the Entrepreneur of the Year award, and it's not really clear what he's created, given there has been no organic growth out of this entity for a few years now. But there's one entity in the world that wasn't audited by Ernst & Young, and this was their Indian operation. Ametek moved into India in 2009 or 10, telling Wall Street, hey, we have great financial ability to integrate these businesses, to grow. Well, it turns out the local Indian auditor gave a very different tune than what management was saying. And in fact, the Indian auditor's opinion matched exactly what the whistleblower said, that the company had no controls for aging of inventory, had bad working capital practices, was delinquent in taxes. And I'm saying to myself, well, this isn't the model of a very good, financially well-managed company. So I started putting all this together, took it a step further, looking at the company's inventory accounting policies. They've very surreptitiously changed from LIFO to FIFO. Over
that kind of a gradual transition?
A gradual transition.
They didn't invent that.
Well, my read of it, the accounting is that if you're going to make an accounting change,
it's in the bag of tricks, yeah.
Bag of tricks. You make the change, you restate whatever financials you have to, and then going forward, you have a new clean slate. But they've seemed to have phased it in very slowly over time. And so, that's another red flag in terms of, the inventory. And then, you also take it a step further. You can look at how the company's inventory turnover has progressed over time, and it's been slowly, decaying. So, I'm pulling all this together and seeing a very different financial picture of Ametek than the company would present, and certainly the Wall Street analysts would present too. Most of them have resounding buys and 20% appreciation price targets on a stock that I look at as very richly valued. And I come to that conclusion from a few different perspectives. Number one, drawing in the valuation data of what Ametek has paid for these acquisitions, I'm finding that they've paid about 9 times EBITDA and maybe about 1.7 times revenues. Well, Ametek's currently valued at 3.5 times revenues and 12 times EBITDA on the premise.
Well, that's great. You can acquire something at 9 and it instantaneously gets revalued at 12.
This is the alchemy of finance that we're in right now. But you look at this and say, well, I would buy into that if it were clear to me that Ametek were adding value to these acquired business. And when I say add value, I say look at expanding margins, look at top line organic revenue growth. But I'm not really seeing that. So there's definitely a valuation disconnect. Furthermore, you look at some of what Ametek's peers trade at. On average, they trade around 11 times 2015 EBITDA. So Ametek trades at a premium to the market, at a premium to the assets it's acquired, and yet has all these red flags and all these question marks around it that I cannot quite reconcile.
Let me just, in a context in the industrial sector, the roll-up strategy isn't exactly also a new idea. Mm-hmm. There's a great book called The Conglomerate Kings. It's probably out of print. Probably 4 people who read it. Mm-hmm. But it goes through, LTV, a lot of the early history of industrial conglomerates, Royal Little. And you can follow that right up through the 80s, the 90s, Tyco later ends up being sort of the heir to that kind of approach. And it does evolve. Maybe they become more specialized, focusing on specific niches. But pretty much the idea of, hey, I'm going to grow through acquisitions and don't worry, it'll all be integrated at some point and work out, mm-hmm. and everything is awesome, is not a new strategy. Why don't people ever step back and say, look, roll-ups blow up. We should stop allocating capital to these companies that do a lot of acquisitions, make a mess at a lot of little companies, and then later kind of fall apart, go through a management change and sometimes an SEC investigation. And why doesn't anybody ever just kind of say like, hey, I'm not paying a big multiple for this?
Well, it's a brilliant question. It's one that baffles me, but effectively, the street seems to be a little bit reactive. It will react when management admits that there's a problem. If management ignores the problem, then it will continue as the status quo. Now, I'm seeing and I'm saying that I think their ability to implement this roll-up strategy is hitting a brick wall, and I have a couple reasons why I think that. Number one is the last two acquisitions they did, Amtech and Zygo, I think were just terrible deals. Amtech had no growth. In fact, they didn't disclose in their press release that it was a public entity. It was in a public entity in London, and so I dug through those filings and saw, hey, no growth, but yet they paid an egregious, 4 or 5 times revenue multiple for it. The other was Zygo, which again had accounting problems, declining margins, declining growth. They paid a 30% premium to the public equity, exactly what Warren Buffett would rail against. And their story has changed. So now here they are buying no growth businesses with issues. Now they're what, turnaround experts? Is this like a publicly traded company that specializes in turnarounds?
Because that's also really worked out well. I mean, if you look at the small companies that some of the, the Dovers and the ITWs of the world, that also wasn't an entirely value creating strategy to basically pick off these smaller industrial companies, roll them into bring the expertise of a large, they'll always have blank business system in there. Not to pick on Danaher. Danaher does seem to be a very well-run company, but typically following that method of some kind of business system that they bring to the small industrial company that just couldn't possibly help itself.
Right.
And then suddenly they're going to expand margins, create all this value, and it never quite happens.
Right, and I think this is more the model for private equity, right? You can kind of do this without the pressure of having to meet
the people who are good at it.
Exactly, and what I also find curious about Ametek is that a lot of the acquisitions that they've made have come directly from private equity companies. And so, if the private equity model is working correctly, and they're fixing up these companies, making them more efficient, making them leaner, then what additional value is Ametek bringing to the table? Right? So I kind of have an issue with that. And then, lastly, to your point is, why does this multiple persist? The last quarter, Ametek effectively missed their numbers, okay? But what happened was the street was cutting the numbers into the earnings so that Ametek could keep its decade-long streak of beating numbers. So they effectively missed if you back out that Wall Street lowered the numbers. And what this has implied now is that the earnings growth rate going forward for Ametek is about 8%. Now this is a big issue because Ametek for years has been saying they're going to grow at 15%, right? So last time I picked up a finance textbook, it told me that when an earnings growth rate came down, a stock price should come down as well. In this case, we have Ametek trading near a 52-week high. Last time I checked, around $54 a share. So, I think we're going to have to retrain a lot of CFAs, a lot of MBAs, and a lot of finance experts out there to explain how stocks go up when earnings growth come down.
It's quantitative easing, I'm sure. So this is a company that has not missed earnings estimates in a decade.
Yes.
It always beats or meets, beats by little or meets. Is it just that Ametek is awesome at managing its core business, or are the Wall Street analysts geniuses?
Wall Street analysts are definitely geniuses.
Or is there a third option I'm not thinking of?
I think part of the issue here is the company's giving themselves a little bit of a cover. And how I think they're doing this is by telling a story to the investors in the street that they have superior ability to source raw materials, to cut costs almost ad infinitum to the point where eventually they'll cut pencils, erasers, and paper. But if you look, the company really exploded their estimate of how much money they could save on acquisitions around 2012. I did a little digging. Curiously, it was right after the CFO resigned. And he resigned right after they announced their largest acquisition ever, a German company called Dunker Motoren. Now, I went to Germany and pulled up the German filings on this company.
They donut-shaped motors.
Whatever it is, it's not really a great business because they told the street that it was going to hit a certain amount of revenue number, and the German filings indicate that it dramatically missed the revenue number. And so what happened was the CFO retired. They changed their clawback language in their proxy to include the word fraud, which really got my attention. And they exploded their estimate of supply chain savings costs and their ability to, extract more savings out of their enterprise. Now, they've been doing this for years, so where they're coming up with these incremental cost savings benefits is, beyond my comprehension.
It's the value of text compare. If you're not text comparing proxies and SEC filings, and you're not reading them as easily as you could.
Right.
So can you tell me a bit about AMETEK management and their board? I mean, it sounds like these are people who know how the game is played, and a lot of the investors who will be long will recognize a roll-up. And if you're playing the game, you get on board with the roll-up. You don't fight. You know what it is. You get long. I'm not, as we said in our call recently on WobTech, we're not prudish about these kind of things. It's, you get on board, you ride them up, but you know what you're on, and you look for the flags, which sounds like you've identified some of them. But one of the things you always want to look at is who is sort of the mastermind behind this? Like, who is my, sort of the person pulling the strings behind the scene and their overseers?
Well, there's no doubt the mastermind is the CEO. I mean, he's been with the company for ages. From all the checks that I've done on the business, he's revered as almost like a godlike figure there. And look, he's delivered great returns for shareholders by engineering a company that avoids scrutiny of investors. And I should have mentioned this early on, but I view AMETEK as a completely regulatory arbitrage company. So what do I mean by that? They report as little to US investors as possible in their SEC filings, and they hide all the dirty stuff in the foreign filings. And so it's a regulatory arbitrage play. But the CEO, I mean, he's an engineer by background, and he's engineered a $15 billion company from, a middle tier sort of industrial company that's been around for decades that did nothing. So, and he's gotten the support of the board, I think, by finding people that are very entrenched and aging and getting older. I mean, you look at the composition of the board, it's one of the oldest boards by age on average if you compare it with other industrials, and it's one of the most entrenched. I think some of the people have been there for a decade or more, and there doesn't seem to be any impetus for change. They're collecting their nice salaries, and the stock had been going up for many years, and so it was working. But all the while, you look at what insiders and the board have been doing. I mean, they sell at every price point possible. In fact, I couldn't find one instance where they've bought stock. At this stage, they own 2% of the company, and the public is saddled with this monstrous stock that's just a bag of decaying companies, in my opinion. So,
or a beautiful roll-up.
Or a beautiful roll-up, depending. The glass is half full or empty, right?
On whether you're a prospective banker looking to break it up or not. I think hopefully everyone understands the sort of the nature of a roll-up. One of the things you do very well in your report is both to identify where it's an outlier. You do a lot of statistics. As you said, the oldest board that came to mind, but also to show sort of how the basically cash going out through the investing cash flows allows them to maybe avoid some capital spending, maybe avoid some R&D spending, and to the benefit of margins, which is also not unique as a game plan, in these kinds of roll-up situations, and sort of put it in a valuation context. But I was wondering, maybe you haven't. Another name you've been working on, which is Greif, which is a name I don't actually know as well.
Right.
But it always shows up on screens, so I've seen the name many times.
Yeah.
And it is Greif, or so Ben tells me. Maybe you could give us a little bit of background there.
Sure. Well, Greif fits the mold on a smaller scale as AMETEK of something I look for. And, we're talking about a very old line American industrial company that has a few businesses. One is paper packaging, corrugated board, rigid product solutions, so this would be like steel drums used by chemical companies, oil and gas companies, flexible solutions, which could be something like tote bags and very commoditized products. And they also have big holdings of timber, which they call land management. So all in all, it's more or less a commodity type business. A lot of competition, which is global. Not a lot of pricing power. They've been suffering a lot because they're very global in nature. More than 50% of revenues come from abroad. They have exposure to Turkey, Russia, Brazil, all the emerging markets, which work well in certain times and bad in others. So, my issue here with Greif is that they pay out a very generous dividend, and they have for a while. And my view is that the dividend will come under pressure at some point, in the near future. It's hard to predict when, but the company has done certain things that lead me to believe this. And number one is financial obfuscation. Okay, so the company has been shifting the goalpost a little bit in terms of how they present their numbers. They take sales of timber and make that an operating gain and say, hey, you should evaluate our cash flow on a sort of steady state going forward business, taking into consideration that we've sold timber, that we've sold a business. Now, I was taught to look at cash flow from a more traditional perspective, which is sort of your baseline business operating cash flow less CapEx.
We call that operations.
Operations, yes, and then avoiding everything non-core or one-time items. They would love you to believe that their operating cash flow is $200 million a year and that their dividend costs them $100 million a year, and so the dividend's well covered. I think if you peel back the layers of the onion here, you find that this is a company that's done a very poor job of covering the dividend in the past. And I think we'll have a tougher time, going forward. And there's other things that lead me to believe this. Number one is they just had their analyst day, and buried in the appendix, where all the investors will have to dig a lot to find, they had their operating cash flow guidance and sort of their CapEx guidance. And then under dividend, they had a blank. Whereas all the previous years, they had the dividend. So I'm saying, well, okay, are they omitting it for a reason? I dug a little bit further. They just filed their new proxy statement. Management has changed the criteria on how they're going to pay themselves bonuses this year.
Oh, that's always an interesting disclosure to note when you get a change in the way people are paying themselves.
Absolutely. Well, in this case, management wants to be paid on EBITDA, and it's understandable. Their EBITDA has a lot of issues, subject to a lot of assumptions, which I've laid out, I think, are problematic.
Note to Keith McCullough, I would like to be paid on EBITDA for the industrial sector, including cash flow from liquidation of assets.
So in prior years, they would be comped on EPS and operating cash flow. And guess what? Operating cash flow is pretty important to determining if your dividend is going to be covered. EBITDA a little bit less much. So they changed that. And then their EBITDA criteria, they list as confidential. So they don't want you to know what their EBITDA target is internally, even though they've told investors a public sort of EBITDA guidance. They have a different one internally.
Well, that makes it very easy for investors to tell whether or not they change the goalpost if you don't disclose it.
Better yet, I mean, you can...
What could the rationale for not disclosing that possibly be? Is it some sort of anti-competitive concern, or?
That's what they would like you to say. I would like to think that in a more sinister case is that they're missing their EBITDA, guidance to the street, and management's still collecting their bonuses, right?
Because, I mean, there should be a way to disclose something that is transparent without necessarily giving up a lot of competitive information.
Well, Greif, the mold with Greif is that they're very opaque, and one of the bigger problems facing them is that they've gone on this acquisition strategy, less aggressive as Ametek, but they've spent $1 billion+ acquiring 40 businesses over a period of 6 years, and have disclosed almost none of the acquisitions they've bought. So you can look at press releases, you can look at the filings. They won't tell you what they've spent $1 billion on, but what I do know is that whatever they bought doesn't seem to be helping them right now. They're struggling. So we just have a company here that has a lot of issues. I think you had asked a very smart question about Ametek and their governance and management. I think Greif also has a lot of problems from a governance perspective, the biggest of which is the dual-class share structure.
Dual-class share structures also have a history of producing excellent governance, sort of like family control of companies. Not always. Sometimes they end up being just fine, but very often you do end up with a situation in which you are, I can't say the word, this is television, but you are the one to which an unfortunate thing is done, as opposed to the one who's doing the unfortunate thing.
Right.
And I think it's very difficult to get rid of a dual class structure. And it's any company that I always think has a dual class structure, one of the easiest ways they could create value for shareholders if they gave a darn about you would be to eliminate the dual class structure, which doesn't seem very likely here.
I don't think it's likely, and you're exactly right. In this case, the dual class structure, disadvantages outsiders. So they have a Class A share and a Class B share. The Class B shares are all the voting shares. So voting on that management bonus change, you have no say as a public shareholder. It's mostly the insiders.
And since you have no say, it really doesn't matter if I tell you what the EBITDA target was or what I bought with your money. It's just,
exactly.
You don't vote.
You don't vote.
You're just tagging along.
Just tagging along. And, in this case.
But trust me, everything is awesome.
Everything's awesome. In this case, if you look at the relative holdings, the management owns about 14% of the Class B and about 2% of the Class A. Now, this has declined dramatically. They used to own about 60% of the Class B 4 or 5 years ago. So insiders are, liquidating this Class B. They hold very little of the Class A, and I think, if this dividend comes under pressure, we're going to see a lot of issues here, because I believe most of the shareholder base is holding it for the dividend.
Well, I think a lot. If you think about risks in the market today, I mean, we've highlighted a few for Hedgeye Industrials, but one of them is simply a lot of investors hold certain equities because of the dividend yield, and that ends up being the primary, decision criteria. And we saw that in the MLP space, where there's a huge amount of risk in these names. Nobody's going to dig in too quickly, because hey, it pays me a nice dividend. Where else am I going to get that? I can't buy treasuries, and I think everyone has the yield problem today. So if anything, like a high dividend yielding name might be like a high short interest name. It may in fact be a big hint that there's something wrong.
Right.
With a given security.
Right. A final thought with Greif that just baffles me here is that you can dig back on the company's website. They post all their investor presentations, and so as part of my due diligence, I went back to see what they were telling investors 10 years ago.
That at least is transparent.
It's transparent. And
FedEx, interestingly, puts their annual reports back to the 1970s, and I think it's a wonderful thing to do. Every company should keep the investor decks out there. As soon as something goes wrong, they delete them. So, if that would be one disclosure positive.
Well, it's not fully transparent, because Greif used to put a nice table with all the data of their price and volume for their segments. That disappeared.
Okay.
But
well, that's terrible. It's reclassified.
It's reclassified. Minor details. Fortunately, I had downloaded a copy a while ago. But you look back at this company, and what they've been telling investors for years is that they have a certain target SG&A margin that they'll hit. There's a working capital margin they can get to. There's growth that they expect. And what I did was I went back all the way to 2004. Look at their investor presentation, and the goals they laid out then versus the goals they just laid out recently are the identical goals. And guess what? Not a single target has been met in 14 years. So if you're an investor out there thinking that management has a game plan to turn around the issues, that management has a plan to preserve the dividend, I would just ask you to think real hard about management's ability to hit the targets and goals that they've told investors, because in 14 years, many of the goals haven't been met. So if you think it's going to change going forward, I suggest you take a hard look and think very carefully about that.
Well, maybe instead of 40 acquisitions, they really need to do 80.
Well, we know the next story is instead of 40 acquisitions, they're going to go on a divestiture strategy of about 20. So,
so the bankers will love this company.
Exactly.
Well, Ben, thank you so much for coming in today and doing this conversation about two of your new favorite short ideas. And again, congratulations on iRobot and LKQ and a couple of the other names you've had out there as good shorts. And I think, for people interested in research process, it's wonderful that you're willing to share the work that you do. I recognize that sometimes people would think that, there's a conflict between, publishing stuff and being involved. I think it's wonderfully transparent. I think you are out there showing people your thesis, showing people your work, giving people primary documents, 700 pages of it, and everyone can learn something from reading some of the work that you put out there. So I appreciate you sharing that with the world. I think it's very kind of you.
And I appreciate your thoughts and for having me and giving me a spotlight here to talk about it.
Perfect. Thank you very much for joining us. You can follow me on Twitter at Hedgeye, INDSTRLS, because we hate vowels. And you can check out other content on the Hedgeye Media website.